Welcome back. Quick experiment. Reach into your pocket, your wallet, maybe the couch cushions. Find a bill or a coin. Hold it.
Okay, crumpled $10 bill. It's definitely lived a life.
That bill, like the one we're looking at on screen, is what most of us picture as money. Physical, printable, hand to hand. But in a modern economy, cash is the small, visible tip of the iceberg.
Right. Cash is real, but it's not most of the money people use. If you measure money broadly, coins and paper notes tend to be a relatively small slice. In the US lately, currency in circulation is on the order of about a tenth of M2, give or take, while the rest is mostly deposits and other near-cash balances.
So, most of the money isn't even a thing you can hold. Is it real or not?
It's real, but it's not physical. Most of it is account balances, numbers in databases, stored on systems like the drive we're showing.
Exactly. Most everyday money is commercial bank deposits. When your banking app says you have $5,000, that doesn't mean there's a neat stack of bills in a vault with your name on it. It means the bank owes you $5,000, recorded on its ledger, and you can usually spend it or convert it to cash on demand.
I always assumed the number was just a pointer to cash somewhere. You're saying the number itself is the money people use.
That's the key. For most transactions, the balance is the money. And once you see that, the next question is obvious. If most money is deposits, how do deposits get created? Because it's not mainly a printing press story, not for your mortgage, your car loan, or your business line of credit.
Right. Governments and central banks issue physical cash. But most of the money we actually spend shows up when banks extend credit and create deposits on their ledgers, within the rules of the system. That's where the magic really starts.
Let's talk about how we think banking works. The piggy bank myth. And yes, the piggy bank on screen is exactly the vibe.
I feel like I'm about to be attacked. But the piggy bank story makes sense. I get paid, I deposit money for safekeeping, the bank pays me a little interest, and then my neighbor, call him Bob, needs a car loan. The bank lends him my savings, charges him more interest than they pay me, and keeps the spread. Simple.
It's simple, it's intuitive. It's the intermediary model. The bank as a middleman, moving existing money from saver A to borrower B.
As a story for how a new bank loan is actually made, it's mostly wrong.
Come on. Mostly wrong?
Mechanically, yes. In that story, the bank has to wait for deposits before it can lend. But in modern banking, when a bank approves a loan, it typically creates a new deposit at that moment. It's not taking a specific pile of your money and handing it to Bob.
Wait, if they don't lend out my deposit, what are they lending to Bob?
A brand new bank deposit. New money in the everyday sense. Look at the graphic. The bank books a new loan as an asset and a matching deposit as a liability.
This is the hard part to picture. We imagine money like water in a bucket. No water in the bucket, no water for Bob.
But a bank isn't a bucket. It's more like the scoreboard you're seeing. When someone scores, the ref doesn't go check a storeroom for spare points. He updates the numbers. Bank lending is like that. The account balances change because the bank updates its ledger.
Okay, I like the scoreboard, but that sounds risky. You're saying when I apply for a loan, the bank isn't checking whether they've got enough cash from other depositors.
They're definitely checking you, credit, income, collateral. And they're checking their constraints, capital, liquidity, and their ability to settle payments if that new deposit gets transferred to other banks. But they don't need a matching amount of other customers' savings sitting there first.
That's why the piggy bank myth sticks. It feels like conservation of matter. But the real system is closer to accounting. Numbers created and destroyed as loans are made and repaid.
Freeze the frame at the instant a loan is approved. Central banks, including the Bank of England, have spent years correcting a key misconception. Banks don't simply lend out pre-existing deposits. On screen, we'll use a simple balance sheet diagram.
Okay, walk me through it. I walk into a bank, I sign a mortgage for $500,000. What happens behind the counter?
When the bank approves it, they don't go to a vault and pull out $500,000. They credit your account with a new $500,000 bank deposit.
They just type it in.
In accounting terms, yes. Look at the diagram. The bank books a new asset, your loan, your promise to repay, and at the same time, a new liability, your deposit.
And here's the kicker. That deposit is new bank money, new spendable balance sheet money. It wasn't transferred from some labelled savings pile.
So the money supply of the entire country just went up by $500,000 because I signed a piece of paper.
In broad money terms, bank deposits, there's now a new $500,000 deposit that didn't exist before, so the total can rise. But it's not magic without limits. What happens next matters. Spending moves deposits between banks, and repayments, or write-offs, destroy deposits.
So yes, it's a magic ledger, but it's regulated ledger magic. An IOU the bank creates and everyone treats as money.
That sounds fake. It sounds like a scam. If they can just type numbers, why do they need me to deposit my paycheck?
Because the bank still has to make payments clear. If your $500,000 ends up at a different bank, like paying a home seller, your bank must settle that transfer through the interbank system, typically using central bank reserves. Deposits help with stable, cheap funding and liquidity. And if the bank needs reserves, it has to obtain them. So lending isn't unlimited.
Think of deposits as the steady fuel and shock absorbers. The lending creates the new deposit. Then the bank has to keep the whole machine balanced.
I'm still stuck on the typing numbers part. It feels like counterfeiting, but legal.
It's legal, and it's how most day-to-day money exists, as bank deposits created by banks when they lend and when they buy certain assets. If bank lending slows while old loans keep getting repaid, broad money growth can slow or even shrink.
Okay, if banks can create new deposits when they make loans, here's the obvious question. Why don't they just type $1 billion for everyone? Why isn't money infinite?
If I had that ledger, I'd be smashing the zero key.
Because it's not free money, it's a bet. On the balance sheet, the loan is an asset only if you can pay. If the bank makes huge loans that go bad, it takes real losses that eat into its capital. And if it runs out of capital, it can fail.
So the keyboard only works when the loan is likely to be repaid.
Exactly. And then there are constraints from the system. Banks have to make payments to other banks, and those are settled with central bank money, reserves. They can usually get reserves as needed, but the price of funding and the rules on capital and liquidity make infinite lending impossible.
So the central bank is basically holding the leash.
More like it controls the terrain. By raising interest rates, the central bank makes funding and borrowing more expensive, demand for loans cools, and bank lending slows. And while some places use reserve requirements, modern limits are often more about capital, liquidity, and whether there are credit-worthy borrowers.
And that connects directly to inflation, right?
Yes, but carefully. If credit and spending grow faster than the economy's ability to produce goods and services, prices can rise. Still, inflation isn't only money printing. Supply shocks and expectations matter too. Central banks try to keep that overall pressure from running hot.
So it's not infinite, because eventually the bill shows up. Defaults hit the bank, and the rules and costs push back.
That's the limit. The magic is constrained by repayment, capital, liquidity, and policy. One last twist in the money life cycle. We know bank lending creates money. So what happens when you pay the loan back?
The bank takes my money and puts it in a vault? or just lends it to someone else?
Neither. When you repay principal on a bank loan, that deposit money is effectively destroyed.
Destroyed as in deleted?
Deleted from the ledger. Look at the balance sheet graphic. Your loan balance goes down, and your bank deposit goes down. Those matching entries cancel. And one important nuance. The interest part isn't destroyed the same way. Interest becomes the bank's income, which then gets paid out, wages, dividends, expenses, and recirculates.
So it's like matter and antimatter colliding.
As a metaphor, yes, like the antimatter lab shot on screen. Two equal and opposite entries meet, and the extra deposit money from that loan disappears. At the economy level, all else equal, broad money shrinks when repayments outrun new lending.
So if everyone in the world paid off their debts tomorrow,
Bank deposit money would plunge. There'd still be cash, and there'd still be central bank money in the system, but everyday transaction balances would collapse unless something replaced them.
That is terrifying and fascinating.
it changes how you look at your bank balance. It's not a pile of gold, it's the bank's IOU to you, inside a living system of credit and debt.
A system that runs on trust and on ledgers, like the one you're literally looking at.
On that note, we'll let you get back to checking your own ledger. Thanks for listening.